Good morning, good afternoon, good evening, or whatever time it is that you are watching this video. I just wanted to create something really quick just to kind of give you some information on a couple different options that you may or may not be aware of that are available to you as a potential home buyer. My goal, as always, is to make you a home owner, but that includes making you an informed home buyer. That's how we get to that end goal that we're trying to reach. So one of the things I wanted to touch on today was the FHA loan versus NACA, which some people know about and some don't. Right now, we are in a crazy time where buying a home to some people seems almost impossible, not just because we can barely go out of our houses, but because things in the mortgage industry have suddenly changed to where there's credit score limits are now higher than what we're used to. And you may have been working to get to a certain point, and now that bar has been raised, and you're like, what do I do now? If you have been kind of keeping up with me on Instagram and Facebook, I've been posting videos and doing live interviews with mortgage lenders and mortgage brokers and kind of talking about that change that has happened ever since the corona virus has hit, and how it definitely has, again, we don't want to scare you away from buying a home, but we want you to know you can still do it. Don't think you can't. So again, I just wanted to kind of give you an idea of these two particular options that are available for you, either in case you didn't know, or maybe you had some information that you were given about one or the other that you just kind of maybe needed clarification on or something along those lines. So here we go, FHA versus NACA. Which option makes the most sense for you? So first off, who are these people? FHA is the largest mortgage insurer in the world. And what that means is you'll get your loan through your financial institution of your choice if they offer the option to use the FHA-backed loan. And what that means is FHA, which is the Federal Housing Association or Administration, excuse me, they basically insure lenders that in the event that you aren't able to pay your mortgage, or you choose not to pay your mortgage, whatever the case may be, they'll step in and take care of that burden. You may lose your home in the process, but the lender still gets their money. So that makes you more attractive as a buyer. And that way, certain lenders or certain sellers may be more interested in yours versus someone who may go conventional, where that's basically on that buyer themselves. There's nothing backing that says if you default on this loan, we may or may not get our money in the event of a foreclosure in a conventional standpoint. And then FHA actually this FHA program actually came along in 1935, which was around the time of World War II. And it was to combat the mortgage conditions of that time. At that time, there was, I believe, 4 out of 10 homes that were purchased, meaning 6 out of 10 were not. Those were renters. It was very volatile back then. And there were a lot of people where you had a mortgage that was due on your house within 3 to 5 years if you purchased in it, not 30 years like we have now. And at the end of that 3 to 5 year period, it was what was called a balloon payment. And if you didn't have that balloon payment, you may have been making your payments on time all that time. But if that balloon payment, which is basically everything that's owed at the end of that term, you have to pay that at that point to keep your home, and if you don't, you lose it. So the FHA stepped in to kind of fix that problem, really. So this is a government program, so that is something you want to keep in mind if you decide to go the FHA route. It works in your favor in certain instances, like this instance where people were able to defer loans, or they were able to get forbearances on their loans that were FHA approved. They were able to, there was a lot of different things that were offered to you because your loan had ties to the government. So that is something you definitely want to keep in mind. Now, NACA, which is the neighborhood, I forget the whole thing, I'll type it out somewhere. But NACA actually is a nonprofit organization who does not have ties to the government, but they are HUD certified, meaning they do whatever it is they need to do to be a part of the HUD program. And they were actually created in 1988 to combat predatory lending. That is lending with subprime rates, and that were basically just not conducive to the low to middle income buyer. So that's what they were around to do, to basically make buying a home affordable. And that's what they have been aimed to do ever since that point. So an FHA insured mortgage, what is that and why is it something you should consider? The main thing is the down payment requirement. It can be as low as 3.5% of a loan, meaning if you are trying to buy a $100,000 home, your down payment is only $3,500, whereas that could be as much as 20% if you were getting a conventional loan, and that's a lot of money. That's $20,000. Who, not everybody has that just laying around to buy a home. So that's the great part of the FHA loan option. You can also get approved despite having thin or credit history problems, meaning they can work around those in certain instances. Now, is that the case nowadays? It's hard to say. At one point, you could have as low as a 580 credit score and qualify for an FHA loan, but as of right now, I think the minimum has gone up to 640. That's a major jump for some people. That 580 to that 640, that can take a month, and who knows what the price of homes will be 6 months from now versus what they are today. So that is definitely something to keep your eye out on if you are in the market to purchase a home at this point and you're thinking about doing the FHA option. Now, they do allow you to purchase single family homes, condos, multi-unit properties, and manufactured homes, which is great, meaning you're not limited to what you can buy. So that is definitely another thing. The condo thing, I believe, if I remember correctly, literally just came around recently. So that was major in the mortgage industry world. You can get funding beyond the amount of your purchase by using what's called the FHA 203K program, meaning if you wanted to buy a fixer-upper and it needed work, you are actually able to finance those repairs and those renovations in your loan. That's not a separate thing that you'd have to worry about. So you have that working in your favor. You don't have to go buy that house that's already dolled up. You can find one and doll it up yourself. That may actually work to your benefit. You never know. So you have that option with the FHA insured mortgage. You can fund your down payment with gift money, meaning you can have family members give you that money. You can go and get grants. You can do all kinds of creative things to finance your down payment, or you can actually request help from the seller. And that is something a lot of people, I don't think they realize. Just because you see a house and you're like, I may be $2,000 short on what the down payment is for my lender, you can actually request help from the seller in the form of what's called a concession. So that's an option for you if you were wanting to do an FHA loan. And don't get me wrong, you can do that on other products as well, but just know that you can do that on an FHA loan as well. There is no prepayment penalty, meaning if you wanted to refinance out of, maybe you got an interest rate that you weren't happy with, or you were one of those 580 credit score people, and then you got your credit score up to 680, and you thought, hey, maybe I can get my interest rate down. You can pay off that loan in the form of a refinance, get a new loan, and either put some money in your pockets or lower your monthly payment. Those are things that you can do with your FHA loan. Now, NACA, on the other hand, they offer no down payment. That is probably one of the most attractive portions of the NACA mortgage. There's no down payments. There's no closing costs. There's an asterisk by that, and I did not put it, and we'll talk about that asterisk later. Closing costs and prepaids are two separate things, and we'll talk about the difference between those later. So do not think you're going to come to the table with absolutely no money to get a NACA mortgage. That is incorrect, and I would never tell anybody that. But the money that you will need can be considerably less than if you were getting a conventional loan or an FHA loan, or even in some cases a VA loan. So even if you have VA benefits, a NACA loan may still be in your best interest if you don't have a whole lot of liquidated, money that you can just toss to a house right now, but you still are in a position, maybe credit-wise, and you've been on your job long enough. All of those things are working in your favor. It's just you're having a tough time getting all those funds for your down payment. So you have that to your benefit. There are no other fees. Mortgage insurance is something that we'll talk about here shortly. I think I mentioned it before, but mortgage insurance is basically the FHA is telling the lender, they're like a third party in the middle office. So they're telling the lender, look, if this buyer, for whatever reason, cannot pay their mortgage, we're going to step in and take care of that. Not take care of that like we're going to pay it and they can stay in the house. You may have to leave, but that lender is still going to get their money. So again, that makes you more attractive to the lender because you have the backing of the government saying, look, if anything happens, we've got that covered. NACA doesn't have those type of fees because they don't do that same sort of thing. But in their defense, they don't think it's necessary because their interest rates are like always ridiculously low. So I believe I actually sat through they now do webinars. They used to do seminars, but ever since the pandemic came about, they went to a webinar format. So I sat through the webinar yesterday, and it was made known to us that the foreclosure rate on a NACA mortgage is like super duper low. I think he said like 0.0012% or something like that, meaning the only way you're losing a NACA home is if you want to lose it. That's the only way you're going to lose it. And that's because certain things that are attached to the mortgage to drive your payment up, and I'm not saying that in a bad way, but I'm just saying if that's what happens, aren't necessarily a part of the NACA mortgage where they may be a part of the FHA mortgage. And we'll look at some numbers a little later on just to kind of give you some visual on that as well. Again, with NACA, you can purchase single family homes as well as condos. Forget my typing in there, I just wasn't paying attention, but you can purchase condos, you can purchase multi-unit properties. Actually, condos, don't quote me on that. I may have to make an adjustment to that, but you can purchase multi-units, meaning if you wanted to purchase a duplex where you live on one side and you can rent out the other, they actually allow that. So you can make money off of your mortgage if you do it right with NACA. And again, you haven't come out of your pocket for very much at this point, and you can buy manufactured homes as well. And they do have a program where you can, if you are doing a fixer-upper, they'll actually allow you to go 10% over in order to get more money to do those renovations and repairs on your new home. So that's an option that they have as well. Now, things to consider if you're going to go the FHA route. In 2019, Ellie Mae reported that the average FHA rate was 5.1%. That's a lot of money and takes away from how much house you can buy in the grand scheme of things when you're looking at your monthly payment. So you can go and look at a house, and that house, because of mortgage insurance, because of the taxes in particular areas, because of your interest rate, you can literally take yourself out of the running from a house because now your monthly payment is more than what you expected it to be, because your interest rate was way higher than you expected it to be. So as of right now, I did look it up on bankrate.com. We're looking at 3.43% on FHA rates. But again, you got to consider this. Your credit score has to be top-notch to get top-notch rates. So if you're one of those people that are teetering on the verge of qualifying for FHA due to your credit score, you're going to be teetering on the higher rate. So that is something to consider if you're going to go the FHA route. Home buyers who use FHA loans do pay an upfront mortgage insurance premium of 1.75%. That is a part of your closing costs. So in addition to your down payment of 3.5%, so let's again just use 100,000 as a round number that makes sense to everybody. We're talking 3,500 just for the down payment. We haven't even gotten to your closing costs and your prepaids. So now on top of whatever you're paying for your closing costs, add in 1.75% to cover mortgage insurance. And your down payment may be higher depending on your credit score. So 3.5% is not guaranteed with an FHA loan. It depends on your credit. So those are things to consider if you're going to go that route of FHA. Do I say not do it? I'm never going to say that. You're going to do what makes the most sense for you, but go into it with your eyes wide open and knowing things that maybe aren't being explained to you in the correct manner. Make sure you find a lender who explains everything to you so that you don't get that shock at the closing table, or when you get your closing documents and you look at that number and you're like, where did this come from? Make sure you have a lender you can trust, as well as a realtor that you can trust. Those two together are going to make your life so much more easy when you're going through the process of buying your home. Now, NACA, things to consider with them. These are things that you may not hear about until you either go through that 4-hour webinar or whatever reason, but there are volunteer requirements. This is not anything that I'm telling you that is not public knowledge. If you go to NACA.com and you download the workbook that they want you to go through the webinar, or through the seminar, workshop, excuse me, it tells you all of these things. So I'm not telling you anything that's a big secret. These are all public knowledge. There are volunteer requirements, meaning they want you to be a part of their mission at least 5 times a year once you buy your home. So you are dedicating your time to this process, not just the process anymore, you're dedicating your time to NACA. Basically for what you're giving in exchange for the things that they're offering you: no down payment, no closing costs, low interest rates. We're asking for your time, or they're asking for your time. You have to register to vote. Now, if you can't because of legal issues, that's different. But if you are eligible to vote, you have to register to vote in order to use the NACA mortgage. Some people, that's a thing for them. Maybe they don't want to. So know this ahead of time before you waste your time and get gung-ho about going this route. Sit down and make sure everybody that's in your household that's going to be on that mortgage, because every adult over the age of 21, I believe is what he said yesterday, has to be considered in the whole package thing. So anybody that's there, they have to be willing to register to vote. So that is something to keep in mind. There also is an annual membership fee. Right now it's $25 a month. So that's really not a major thing. But again, that's just something that I've been dealing with the NACA program for years now. I did not know that was a thing that you kept going as long as you had that mortgage. I thought that was something you only paid while you were going through the process of qualifying. And then once you got into your home, you just have a home. Nope, that's a fee that you pay every year. So again, if you're okay with paying that, again, it's very minimal, $25 a year. Just know that that's something you have to keep in mind, that you have to do if you want to get the NACA mortgage. They do place what's called a soft lien on your home. Does that add any money to your mortgage? No. Does that add any money to your bottom line of how much you own, you will eventually own your house? No. It's basically like an incentive for you to do the right thing. And the right thing is stay in the home, meaning you're not going to buy this house and then 5 years from now decide, I want to move from Florida to California, but I want to rent this house out that I got through NACA in Florida and hope, fingers crossed, that no one finds out. No, if they find out, you owe them $25,000. So just keep that in mind. Are you able to sell your home? You can absolutely do that. So you're not tied into that house for the length of your 15 or 30-year mortgage. You can sell at any time. There's just a couple minor things you have to do. From what I saw, they aren't very, it doesn't look like it's too strenuous. It's pretty simple stuff you have to do. But you cannot not live in the house. You can't have your mom living, I mean, maybe you, I don't know, I'm not going to go that route, but if you were trying to have someone live there in your place and you wanted to like have, you know, charging them, maybe, I don't know what you have planned, but just know that that is what that is. $25,000, that's basically a fine if you are found that someone is living in your house and you are not, and there is a NACA mortgage attached to it. This mortgage is offered by Bank of America. So if you have issues with Bank of America for whatever reason, know that that's who's going to hold the note to your house if you get a NACA mortgage. So again, these are things that you may not upfront know, but I want you to be an informed buyer when you make these decisions to either go the NACA route or go FHA or go VA or go conventional. These are things that you definitely want to keep in the back of your head. Now, I have dealt with the entire process from beginning to end with a client once. I've had more than one, but one actually went through the entire thing. Is it stressful? Yes, I'm not going to ever tell you no, because I'd be lying to you. It is very stressful. There are certain things that you are going to want to do that will make your life easier. And if you don't know ahead of time to do them, you're going to hate this whole process, and it's just going to take the wind out of your sails at some point. And again, this is supposed to be the most magical thing in your life other than maybe having children or getting married. So nobody wants to make it a terrible experience, but it can become one very quickly if things aren't going in the direction that they should. But before we even get to that route, let's go to those numbers that I was telling you about. Hopefully this is big enough. Let me make it a little bit bigger. Okay, so this is directly from NACA's book. So again, this is not anything that I'm stealing. This is from their book, NACA.com. You can go download this and you can see it yourself. So these are just numbers that they put together. This is a traditional, so this isn't necessarily FHA, but you can put you can end up having to put 5% down on an FHA loan. So it's doable. So this is based on a house that's $100,000. They didn't change anything. If you made an offer and you said, hey, in your offer, I'm going to give you a deposit of $1,000, that goes towards your bottom line. So it's something that, you know, you're putting towards the house, but it can also come off of what you owe for your closing costs. Home inspections right now, they're ranging all across the board. So they can be as low as $300 or $400. They can be as high as $800 or $900. It depends on who you want to use and what services you decide to get. So that's not going to change. You will have to pay for a home inspection. That's money you have to come up with. The attorney, meaning whoever closes your loan, that's nothing you have to worry about. Your credit report, you have to pay for your credit report when you go through the process with the lender. With NACA, they charge, I think he said it was $12.13, and that's because that's what the bank charges them, and they pass that off to you. So you have to pay that, and there's like a little bit more if you're a married couple. Application fee. I've never seen an application fee that high before on a mortgage application. I've never seen one, period. So I would not take this with a grain of salt. It may depend on who you go through, but NACA doesn't have an application fee. So that's one less thing you have to worry about. Just that $25 that I was telling you about for your membership fee. Appraisals, that's about $450 to $500, $600. That's something you do have to pay for up front in the mortgage process. If you're going to go the traditional route, NACA, you will pay for it, and then they basically will take it off of what you owe at closing. So they're basically paying it for you, but you have to pay it up front. Down payment. If you were trying to buy this house, you are putting, actually no, $10,000, that doesn't make sense. This would be $5,000, that wouldn't be 10. So you're talking a down payment. That's money you've got to come up with. Whereas it's NACA, you don't have to come up with that. That's a zero number. Origination fee, that depends on the lender that you're going to go through. You're going to pay somewhere around this. You don't have to pay that with the NACA mortgage. Document preparation fees, those can range depending on the lender. Again, you don't pay for that with the NACA mortgage. Lender's title insurance, that's something you have to pay at closing. unless you kind of work these numbers out with the seller to maybe the seller's going to pay for it. Hey, you never know. With NACA, you don't have to do it because the Bank of America, if I'm not mistaken, Bank of America actually covers that, so you don't have to pay for that. Mortgage insurance for the first year, that's a part of your closing costs if you use a conventional or FHA loan product. NACA does not charge that, so you don't have to worry about that as a part of your closing costs. Lender's attorney, that is your closing, what they charge basically for doing all this work for you, the title company. NACA uses their own title company, so that's not anything that you're going to pay for. Now, your homeowner's insurance, that again is going to depend on your home, how old it is, certain things about the home, where it's located. So they just gave a round number of $1,200. That's not going to change. So that's something you have to consider as a part of your closing costs, either way it goes. So that's something you just be aware of. Other lender fees, that can be ranged from anything. They just gave a round number of $350. Again, there are no other lender fees that NACA has to charge you. So let's go down to your prepaids. Remember I said there's closing costs and there's prepaids. Prepaids are basically, we're going to put some money aside to cover a certain amount of your taxes, of your mortgage insurance, of your payment in certain cases, and your home insurance. We need to get that money up front so that we can pay that ahead of time. So there are certain things that are paid in advance. There are certain things that are paid after the fact, kind of like having a prepaid phone and having a postpaid phone, sort of kind of same thing. So your prepaids are things that that's not a part of your closing costs, and it's not a part of your down payment. That's additional money that you have to come out. So in this case, if we're looking at a mortgage insurance of 2 months, which right now, with the way things are going, there are banks that are asking for more than that. So we're talking, this is 2 months, so they're saying that's what, $150 a month. What if that was $150 a month and they want 6 months worth of prepaids? So that's a lot of money to add on top of your down payment and your closing costs. And then we're talking homeowners insurance. That's going to be the same either way. So you have to pay that. That's neither here nor there. If you're going to get the FHA conventional or NACA product, you will be paying that at closing. Your real estate taxes, again, you will be paying that at closing. So that number is not going to change. And your prepaid mortgage insurance. Now that number, again, because according to what I read or I remember from the webinar, that is, oh no, interest. I'm sorry, I'm thinking mortgage insurance. That's interest. So you do have to pay your interest and closing. So PITI, basically that's your purchase, that's your insurance, that's your taxes. That's all of that stuff is rolled up into one number. And they want you to pay a month of that. NACA does. They want you to pay a month ahead, whereas in a mortgage situation with FHA or conventional, that may not be the case. So that's probably the one case where you're paying on the you're paying on the NACA side, but not necessarily paying that on the FHA side. And then there's interest buy down, meaning if you want to make your payment less per month, you can actually pay upfront. Pay more interest up front, and that will lower your payment. That, again, you can talk to your lender about those numbers and making those make sense, but that's optional money. That's not anything you absolutely have to do with either one, but that's an option. So right now, just going off of these numbers, we're looking at $18,000 that someone may need to close on a house, whereas if you're going through this NACA mortgage process, we're just under $4,000. So as you can see, there's a lot of savings in that. And being that the interest rates that they offer are so low, it kind of gives you more, it does. It gives you more purchase power, meaning you can buy more house for your money because your interest rates aren't super duper high, or you don't have to necessarily worry about what are my interest rates going to be. The way it was explained during that webinar, whether you have a 500 credit score or you have an 800 credit score, you're going to pay the same interest rate. So it doesn't matter. If you want to go lower, then you just pay out of pocket more money up front, and then you can lower your interest rate, which in turn lowers your monthly payment. So that's something that you have the option to do. But those are the things I just kind of wanted to give clarification on. If you're going to use either one of those products, you're not going to go wrong. Just know what you're getting into before you do it. And if you have any questions about either one of those, definitely reach out to me either by phone, by text, social media, however, email. I'm always here to answer those questions. And if you need to get in touch with a reliable lender, I have a list of those available as well. So let me know if there's anything that I can do for you, and I'll do whatever I can. Again, my goal is to make you a home owner, but that first means making you an informed home buyer. So thank you again for spending some time with me. Let me know if there's anything that I can do for you. Whether it be in Florida or in Arizona, I can still assist you either way. Thanks for your time, and I'll see you guys later. Bye.